There is a category of property that has existed in British towns and cities for over a century that represents a genuinely significant share of the total UK housing stock and that carries a specific set of financial and legal risks that almost nobody explains to buyers before they commit to a purchase. That category is the flat above a commercial premises, the 1, 2 or 3 bedroom residential unit sitting above a takeaway, a convenience store, a hairdresser or a betting shop on the high street. These properties look, on the surface, like straightforward residential purchases, often priced below comparable flats in purely residential buildings, which can make them appear to represent good value. The price discount is real, but for a significant share of buyers in this category, that discount does not adequately reflect the ongoing costs and structural disadvantages the purchase brings, and the gap between apparent value and actual value is one that only becomes fully visible over time, typically at moments, a remortgage, a sale, an insurance renewal, when the buyer has very limited ability to do anything about what they have discovered. I have been tracking the UK property market for years, and the flat above a shop deserves its own dedicated video. Not because the risks are exotic or rare, but because they are consistent, largely undisclosed at the point of sale, and considerably more financially consequential than most buyers realise before they have already committed. Let's start with what actually makes a flat above a commercial premises different from a flat in a purely residential leasehold, because the distinction matters at every stage of ownership. A mixed-use building, meaning a building that contains both residential and commercial space, creates a set of legal, financial and practical complications that simply do not arise in a purely residential leasehold. The commercial tenant or owner of the ground floor unit has different rights, different obligations, and a different relationship with the building's freeholder than the residential leaseholders above. The building's insurance, maintenance, and management has to serve both uses simultaneously. The noise, odour, footfall and hours of operation associated with whatever business occupies the ground floor are not something the residential leaseholder above can control, change or, in many cases, meaningfully complain about through any straightforward legal route.
Red flag number 1, the mortgage lender restrictions that affect a meaningful share of flats above commercial premises. Major UK mortgage lenders apply specific criteria to residential lending on mixed-use buildings, and those criteria are considerably more restrictive than most buyers are aware of when they are viewing the property and falling in love with the kitchen. The most common lender restriction is based on the nature of the commercial use on the ground floor. A flat above a conventional retail shop, a solicitor's office or a bank branch is likely to be acceptable to most lenders. A flat above a hot food takeaway, a pub, a betting shop, a pawnbroker, a tattoo parlour or certain categories of convenience store is likely to be unacceptable to a meaningful number of lenders, either because of the specific reputational or fire risk associated with that type of commercial tenant or because of lender policies about the desirability of the residential use in proximity to specific commercial categories. The practical consequence is that a buyer who has obtained a mortgage agreement in principle and who has not yet disclosed the specific nature of the commercial use on the ground floor may discover at the valuation stage that their chosen lender will not proceed, leaving them to find an alternative lender who will accept the property, often at a worse interest rate, or to withdraw from the purchase. The interest rate differential between a mainstream lender and a specialist lender willing to accept a problematic commercial use category can be meaningful, running to a full percentage point or more in some cases, which on a mortgage of £200,000 represents thousands in additional annual interest cost that the buyer had not factored into their affordability calculation when they made the original offer. Red flag number 2, the building insurance structure that creates a conflict of interest the residential leaseholder has no practical means to resolve. In a mixed-use building, the building's insurance typically covers the entire structure, commercial and residential elements together, under a single policy. Who arranges that policy and who pays for it depends on the specific building structure, but in many mixed-use leaseholds, the freeholder arranges the policy and recharges the cost to all tenants, residential and commercial, through their respective service charges or lease obligations. The conflict of interest arises because the nature of the commercial use on the ground floor can significantly affect the insurance premium for the entire building, and a residential leaseholder above a hot food takeaway is paying an inflated building's insurance premium that reflects the fire and liability risk of that commercial operation, without having any ability to change the commercial tenant, negotiate the insurance terms, or challenge the premium structure in any straightforward way. As I have covered in previous videos on this channel, the insurance commission structure in leasehold buildings already creates alignment problems between freeholders and leaseholders, and in a mixed-use building, those problems are compounded by the additional commercial risk element.
Red flag number 3. The noise, odor, and antisocial hours that are a predictable feature of certain commercial uses, but that buyers systematically underestimate before purchase. A flat above a takeaway that operates until 2 in the morning is not simply a minor inconvenience, it is a sustained structural feature of daily life that affects sleep, affects the marketability of the property when the owner eventually wants to sell, and in severe cases affects physical health through long-term noise or odor exposure. Estate agents are legally required to disclose known material facts about a property, but the subjective experience of living above a specific commercial use, the reality of what Friday night at 11 p.m. sounds and smells like from the bedroom directly above the extraction unit, is rarely captured in any document that forms part of the sale process. Buyers who visit a property on a Wednesday afternoon at 2 p.m. and find it pleasantly quiet have not experienced the property under the conditions that will define most of their evenings and weekends as residents. The gap between a daytime viewing and the reality of a Friday night can be dramatic, and it is a gap that estate agents have no particular incentive to bridge for a buyer who has not thought to ask directly, since the viewing is structured to facilitate a sale rather than to provide a comprehensive sensory experience of the property across all operating conditions of the commercial unit below. Red flag number 4, the service charge governance gap in mixed-use buildings where the residential leaseholders are a minority of the total building occupancy by floor area. In a building where the commercial element occupies the majority of the total floor space, residential leaseholders may not qualify for the right to manage at all, leaving them with fewer practical routes to challenge service charge levels or management decisions than residential leaseholders in purely residential buildings would typically have available.
Red flag number 5, the valuation and resale difficulty that accumulates over time as lender criteria tighten and the pool of willing buyers narrows. A flat above a commercial premises that was mortgageable through a wide range of lenders a decade ago may today be mortgageable through only a narrow range of specialist lenders, particularly if the commercial use on the ground floor has changed or if the nature of the business has moved into a category that lenders now treat more cautiously. That narrowing of the eligible lender pool directly reduces the buyer pool at the point of resale, since fewer buyers can obtain mortgage finance for the property, which in turn depresses the achievable sale price. A buyer who purchased with a mainstream lender at a competitive rate, assuming the property would be equally straightforward to sell, may discover at the point of sale that the market for their property has structurally narrowed in ways they could not have predicted at purchase. Now, here is what connects all of these red flags together. There is a 6th dimension worth naming that cuts across all of them, which is the specific difficulty of obtaining accurate pre-purchase information about any of these issues. The commercial lease, which determines the hours, the use class, and the permitted activities of the commercial tenant, is not automatically disclosed to a residential buyer during a standard conveyancing process. The insurance policy covering the whole building may not be obtainable as a document during the purchase process without a specific and direct request. The service charge accounts, if they exist at all in a building with a mixed commercial and residential structure, may be organized differently than in a standard residential leasehold. Each of these information gaps means that a buyer who relies on the standard conveyancing process to surface all material facts about the property they are purchasing is likely to miss one or more of the issues described in this video, not because their solicitor is negligent, but because the standard process was designed around purely residential leasehold transactions and does not automatically extend to all the specific inquiries that a mixed-use building requires.
A flat above a commercial premises is not simply a residential property with some additional inconvenience attached. It is a fundamentally different type of asset that operates within a fundamentally different legal and financial framework, one where the residential occupant's interests structurally subordinate to the commercial operation below in ways that are not visible from the outside, not disclosed in standard property marketing, and not easily reversible once a purchase has been made. The price discount that makes these properties look like good value relative to comparable flats in purely residential buildings reflect, at least in part, the structural disadvantages of the mixed-use position. In some cases, the discount is commensurate with those disadvantages, and the purchase represents reasonable value for a buyer who has understood what they are taking on. In other cases, the discount is insufficient relative to the actual risk and ongoing cost profile of the property, and the buyer who is attracted by the apparent bargain discovers the full picture only after they are already inside it. I spoke with a mortgage broker who works with a significant volume of residential purchase transactions, and off the record, her assessment was direct. She said the flat above a shop is consistently one of the most problematic purchase categories she encounters, not because the issues are impossible to navigate, but because buyers, and in some cases their solicitors, arrive at the transaction without having properly identified the commercial use and its implications before agreeing to a purchase. She said her standard practice is now to ask about commercial elements on the ground floor at the very first conversation with a new purchase client, because discovering the issue after an offer has been accepted and surveys have been instructed is considerably more disruptive and expensive than identifying it before the offer is made. She described one case where a buyer had already paid for a survey and instructed a solicitor before it emerged that the commercial unit on the ground floor was a hot food takeaway operating until midnight 7 days a week, and that 2 of the 3 lenders the broker had been considering were unwilling to proceed on those grounds. The buyer withdrew, losing survey and legal costs, and the broker said the entire situation would have been avoided by a single question asked before the viewing rather than after the exchange had been contemplated.
So what does this mean practically? First, if you are considering purchasing a flat in any building that has commercial space on the ground floor or elsewhere in the structure, establish the specific nature of that commercial use before you make an offer, and research specifically which lenders will and will not accept that commercial use category before proceeding. Second, ask specifically whether the building has a single combined buildings insurance policy covering both commercial and residential elements, who arranges it, whether any commission is paid, and how the premium splits between commercial and residential occupants. Third, visit the property at multiple times of day and multiple days of the week before committing, specifically to assess the noise, odor, and footfall reality of living in proximity to that specific commercial operation. Fourth, ask your solicitor to specifically research the service charge governance structure and the right to manage eligibility in the building, because the governance protections available in a mixed-use building may be significantly more limited than in a purely residential one. Fifth, if you are already an owner in a mixed-use building and you are planning to sell, take specific advice from an estate agent who has experience in this property category before pricing and marketing, because the buyer pool and the valuation methodology are different from a purely residential sale, and generic estate agency advice calibrated to the mainstream residential market may lead you to price incorrectly and market to the wrong audience. Here is how I expect this to develop. Lender criteria around commercial use categories are more likely to tighten than loosen over the coming years, as lenders continue refining their risk models for mixed-use residential lending. The specific categories most at risk of further tightening are those associated with late-night trading, high footfall, fire risk, or reputational concerns, which covers a significant share of the most common commercial uses found below residential flats on UK high streets. Expect the effective buyer pool for these properties to continue gradually narrowing, and expect the price discount required to attract that buyer pool to gradually widen, particularly in areas where the high street commercial environment has deteriorated and where vacancy and changing commercial tenants have introduced uncertainty about what the ground floor will look like in 5 or 10 years' time. It is also worth watching how the ongoing decline in high street retail affects the mixed-use residential market more broadly, because a flat above a vacant commercial unit or above a unit that has cycled through multiple short-lived tenants in recent years creates its own specific uncertainty around noise, management, and future use that is different but related to the challenges described throughout this video. The uncomfortable truth is that the flat above a shop has been sold for decades as simply a flat, priced at a modest discount relative to comparable residential property without the commercial element. That discount is sometimes adequate compensation for the structural disadvantages it reflects. More often than not, it is not, and the buyers who discover this most painfully are the ones who purchased on the basis of what the property appeared to be at a Wednesday afternoon viewing, rather than on the basis of a thorough investigation of what it actually is as a legal, financial, and practical asset across all the dimensions that matter once you are living in it. The single most valuable thing you can do before buying in this category is ask a different question than most buyers ask. Not, is this a nice flat, but what exactly is below it, who controls it, and what are all of the ways that affects my experience of owning this property for the next decade.